Greetings traders and welcome back. Thank you for joining me for another In-Depth with Chris episode. Today's subject will be the long straddle. The long straddle is an options trading technique that has limited downsides with the potential to lower our risk. And anything that seems valuable in the trading world, you better believe I'm going to share it with you. So without further ado, let's sit back, relax, and learn a thing or two about the long straddle. Bzz. The long straddle is a very popular options trading strategy that allows traders to limit some of their risk if done correctly. But what is it? The long straddle is a combination of both a long call and a long put. Both have the same strike price and same expiration date. So what we need to focus on here, because remember, in the options world, we have long calls, we have short calls, we have long puts, and we have short puts. Now in this case, we're talking about a long call and a long put. So we're going long on both of these scenarios, but one is a call and one is a put. So it's about as opposite as it gets, but they are both long statements. So once again, long call, long put, we have ourselves a straddle. The strike price is generally close to the current price of the asset. Either the call or put can be in the money depending on how price deviates from the strike price. The trader will lose all their money if there is no movement in the price of the asset, because in this case, the call and put would both be worthless. So we need the market to move in order for a straddle to be useful. Now, when the trader is purchasing both a call and a put, a long straddle option incurs a higher cost than the trader would have paid from only buying either one or the other. Now, this strategy is particularly useful for traders who expect a significant price movement but don't know the direction of that price movement just yet. The trader gains more profit the farther the share price moves in the money. For my highly logic-minded viewers out there, let's take a moment to talk exactly about how it works from a theoretical standpoint. The first thing that happens is if the spot price equals the exercise price, the value of a call will be equal to 0. And at the same time, the value of the put will be equal to 0. So this is a scenario that we're not looking forward to. We don't want the value of the spot price to equal the exercise price. Then we have another potential scenario where the spot price, which will be S, is going to exceed the exercise price, which will be X, and in this scenario, the value of the call will be equal to S minus X. So if the spot price is 120 and the exercise price is, say, 100, then the value of the call would be 20. So simple math there, nothing really that wild. The value of the put, unfortunately, will be 0, and the reason is the spot price has exceeded the exercise price. So in this case, that's not the direction you would want your long call to be moving. And then we have option number 3, or scenario number 3, which would be when the spot price, S, is lower than the exercise price, X, then we have a situation where the call is now worthless, equaling 0, and the value of the put is going to be found with X minus S, because it's the other way around. So it'll be the exercise price minus the spot price to find out the value of the put. So to summarize these three scenarios, we can basically just say that all we need to do to calculate the long straddle is just pay attention to the difference between the spot price and the exercise price, which was our S and our X. Now, naturally, it's going to be dependent on which one we are analyzing, whether it's the call or the put, on whether we're minusing the spot price from the X or we're minusing the X from the spot price. But regardless, the math is relatively simple. However, this doesn't include what is called the premium. Let's take a moment and visualize how the payoffs actually work with the help of a couple graphs. If we were to pretend that we have an exercise price being offered, meaning our strike price at the moment will be $50 and our cost to purchase is 10, this is going to represent our premium, but we won't even focus on the premium just yet. Let's just focus on it simply with a $50 strike price for us. So at a $50 strike price, we're looking to go up and we're looking to go down. So we're going to pretend at this yellow box, we open a trade going both up and down. We have a long call and we have a long put. Now, in this scenario, the long put is going to gain whatever the difference is as price declines. So if price declines to, say, $40, that's a difference from our entry of $50 of 10, which means our payoff for the put would be 10. And as far as our call, when price starts increasing, which technically can go on to infinity, we have a scenario here where if it rises to, say, $55, then we've changed 5, which means our payoff for the long is going to be 5. So the idea here is relatively simple. Without focusing on premiums, it is simply a subtraction problem just to see what the difference is between the spot price as well as our final resting price. Now let us consider the impact that the premium has on all of this. And the premium is what we are going to have to pay. And in this scenario, we said that it was going to be $10. On our previous image, remember, it was $10 but a $50 strike price. So the yellow box represents our $50 strike price. But now all we need to do is minus the premium from the final numbers that we're going to receive. Because of this, now, because we have a $10 minus situation going on, as we lose, we are going to lose the premium of $10. That means if the market does not move, we lose $10 just due to the premium, not counting anything else. Then as far as, say, the spot price goes, if it were to move down to $45, we're going to lose $5. The reason we're losing $5 is because we've gained $5 on the side of the put, but we haven't actually overcome the premium just yet, so it's still a -5. And if it were to go the other way, the same thing would happen. If we gained $5 on the call side, we're going to subtract 5 from that 10 initially, but we're still not over the hump just yet. So if we look at a graph here where we have the payoff scouted out here, we can see that this graph, the blue line, is going to represent the actual premium, and because of that, you can see that the premium line is actually able to dip negative, whereas our previous line before would only go to 0. It wasn't possible to go negative. So obviously the premium is the cost of business, and it does need to be factored in when we are figuring out what the cost of our position will be and where our profit point will be, our break-even point. At this point, you should have a strong understanding of what a straddle is and the basic functions of how it operates, but let's talk about how it can help us as traders. The long straddle is particularly helpful whenever a trader expects a significant change in price without knowing the direction. A strong example of this would be during a time of news. If we have a powerful news release coming out and we are anticipating a strong move, but we're not sure exactly which way that move will go because we don't know the numbers just yet, but we do know that historically speaking, with whatever news release that we're hypothetically talking about, we've seen large moves. Well, then a straddle could be a very beneficial option for us because we can go both long and short, and we don't need to worry about which way the market goes. We only care that it moves a great deal in either one of those directions. So traders tend to use long straddles during periods of high implied volatility, or when the trading asset is very, very active, when we have a lot of action going on that's causing the market to make strong moves in either direction. Using straddles during periods of market crashes, for example, with what's going on now with the coronavirus, we've seen traders pull very comfortable profits with relatively low risk. Traders generally don't want to use the straddle during those periods where the market is range-bound and hardly moving. Which brings us to our next point of contention, long straddle strategies. Now, during an announcement or event, we essentially covered the idea is to generally buy the straddle when there is an announcement regarding earnings or performance of a company that is expected to have a large magnitude. During these instances, the outcome can play a significant role in the movement of price, meaning those particular numbers that come out can have a significant impact on the price of the asset that we're analyzing, and as such, going up and down can can get us into whatever ride the market is about to take. Then we have number 2, which is when the implied volatility of a share is low. The implied volatility of shares can be calculated using different models and is generally widely available information. Now, using this information, this would make sense for us to implement a straddle during the correct moment when the implied volatility is low, because this would be allowing us to jump into the market before the implied volatility gets high. During the period that the implied volatility is already high, we may be already too late to the party. Then with number 3, we have economic slowdown or growth. When there is significant slowdown or growth in the economy, it often translates into movements in the broader markets. Traders can buy a straddle when they anticipate these large changes in the economy. And then number 4 is buying a straddle that's not in the money. We could have a bias in the direction of movement according to a tweak with the exercise price itself when we're analyzing it technically speaking. And using this analysis on top of employing a straddle can make the straddle all the more profitable while still preserving our capital in the way that a straddle generally would. You may be wondering if it is possible to do a short straddle, and the answer is absolutely yes. The only difference is instead of a long call and a long put that we do with the long straddle, we're just doing a short call and a short put. The same concept applies, but the differences between the two of them should be highlighted. So in this graph, we can see exactly what that is. The long straddle is going to be useful when there's a significant movement anticipated with whatever it is that we want to use the straddle on, whereas the short straddle is going to be useful when the price is range bound. So we do the short straddle during the markets that we cannot or do not want to do the long straddle. And then as we move on, the long straddle also involves simultaneously buying a call and a put with the same expiry price and time. The difference here is with the short, we are just doing the short variation like I said. So we're selling a call and we're selling a put. So once again, short sell synonyms. And then with the long straddle, our loss is capped at the premium charged by the straddle. The short straddle, this is where things get quite a lot different, and I'd like everyone to pay attention to this, and this is why I personally prefer the long straddle. With the short straddle, there is no limit on the loss amount, and this is due to the fact that the position involves a short call as well, which means it theoretically could go against you forever. And as far as the premium with the long straddle is paid up front to purchase the straddle. The short straddle, however, gets a very cool factor to it, and this is what entices people to short straddles, and that's the fact that they receive a premium immediately up front. So profit in hand right away, whereas we're looking to make our profit with the long straddle. Now for some frequently asked questions to make sure we understand the long straddle. The most commonly asked question is, when is the market at maximum profit potential for a long straddle? And the answer here is there's theoretically no limit to the maximum profit that can be realized using a long straddle. Now, this means that if the market were to continue rising or continue falling, the profit could continue coming in till infinity in that regard, but in the scenario that it's falling, obviously there has to be a zero at some point. But as number 2 comes in, how risky is it to buy the long straddle? Well, the maximum loss that we can incur when we're trading the long straddle is the initial premium that was paid. We can't lose any more than that. What we pay to open the trade is all we stand to lose with the long straddle. Now, number 3 is how to get out of a long straddle with our earnings, or in the case that we just want to close it out. In order to exit a long straddle, the trader needs to exit the position from both a call and a put. So remember, we just have 2 positions open, and we need to do the opposite of either of those to close them out. And then for number 4, we have, when is the long straddle profitable? Well, we've talked about this, and the long straddle is profitable during those extremely volatile periods. The strategy breaks even when the price moves beyond the premium point. So everything beyond the value of the premiums paid to open the 2 trades will be profit once we move beyond that cost. In conclusion, the long straddle is something that can be very useful if you have reason to believe that the market is about to produce some serious action. If the market is going to fly upwards or fly downwards, the long straddle can be a very solid way to take advantage of that move without needing to be correct on the direction. That alone is a very freeing feeling in the trading world, not needing to know which direction it's going to go, but instead just needing to know if it's going to move at all. Some people people feel that it makes it easier on them in the options world, but nonetheless, I hope you have good luck if you do start employing the long straddle. It's a very cool tool, and thank you for joining me again as always, folks. Please, before you go, click that like and subscribe button down below. I will see you on the next one, folks. Cheers, everyone. Over and out.